Welcome to the show, everyone. I'm Mayowa Adeyemi, here with Oluwase. And Oluwase, I want to start today with a scenario that keeps many finance directors awake at night. Picture this. A Nigeria Revenue Service auditor walks into your office, sits down, and asks you to produce a physical withholding tax credit note or a custom clearing document from September 2018.
September 2018? Mayowa, that is over 6 years ago. Most businesses have changed physical offices, migrated their ERP systems, or frankly, lost those dusty paper files in some damp warehouse by now. Isn't there a statutory cutoff for how far back the NRS can go?
You are spot on about the standard rule. Under Nigerian tax laws, specifically Section 66 of the Companies Income Tax Act, there is indeed a 6-year limitation period. Once 6 years have passed, the NRS generally cannot reopen your books for a back duty audit. But, and this is a massive but, that statutory clock completely vanishes if the Revenue Authority finds any trace of fraud, willful default, or neglect.
Wait, willful default or neglect? Those are incredibly heavy terms. Does that mean if a business simply cannot find a specific invoice from 2017, the NRS can interpret that missing paperwork as deliberate neglect and blow the 6-year limit wide open?
Exactly. That is the trap. To a tax auditor, disorganized bookkeeping is not viewed as an innocent mistake. If they find a discrepancy between your bank statements and your declared revenue, and you lack the source documents to explain it, they can categorize that as a deliberate misstatement. Once they invoke that clause, the 6-year limit is lifted indefinitely. They can audit you from 10, 12, or 15 years ago.
Indefinitely. That is a terrifying operational risk. It means your tax liability never truly dies if your paperwork is a mess. So, to protect themselves from this infinite retrospective probe, what are the absolute non-negotiable source documents a business must preserve?
You need to secure the original paper trail. First, your VAT invoices and sales receipts to prove top-line revenue. Second, your withholding tax credit notes. Because without the physical or digital evidence of those credits, the NRS will not allow you to offset your income tax. And third, for companies importing raw materials or equipment, you must hold on to your import assessment papers, specifically your Form M, the bill of lading, and the single goods declaration slips from customs.
The single goods declaration. Yes, because if you claim you imported 10 industrial mixers to justify a capital allowance deduction, but you can't produce the SGD slip showing the duty paid at the Apapa port, that entire tax write-off gets thrown out. The auditor will simply assume those mixers don't exist.
And that brings us perfectly to the second core issue, Oluwase. Tax auditors do not live in the clouds of your digital spreadsheets. They want to see how the numbers on your laptop screen connect to the physical dust on your factory floor. You cannot just show them a line item in QuickBooks that says 5 million naira spent on diesel and expect them to nod and move on.
Right. They want to see the physical reality of that diesel. I always tell business owners that your ledger is just a story, and the source documents are the physical evidence. For that 5 million naira fuel expense, an auditor is going to ask for the generator logbooks, the fuel delivery receipts from the filling station, and even the security gate logs showing when the fuel tanker entered your facility.
Exactly. They look at the generator logbook to see if the hours run actually match the volume of diesel consumed. If your logbook says the generator ran for 50 hours, but your purchase invoices claim you bought 10,000 liters of diesel, the math does not hold. They will disallow the expense and slap you with a hefty back tax assessment.
It is all about the operational reality. The same goes for raw materials. You can't just have a supplier invoice. You need the warehouse delivery note signed by your store manager, confirming that 50 bags of flour actually arrived at the warehouse, alongside the corresponding gate pass. It's about building a watertight, multidimensional defense.
It absolutely is, and this is why I advise every business owner to conduct what I call an internal mock tax audit once a year. Do not wait for the NRS to send you a formal letter.
A mock audit. I love that proactive approach. Walk us through how a business owner actually executes this. What is the step-by-step checklist?
Step 1 is the three-way match. Take 20 random expense transactions from your ledger. For each one, you must locate the local purchase order, the warehouse delivery note, and the supplier's original VAT invoice. If any of those three are missing, your trail is broken. Step 2. Do a physical asset tag validation. Look at your fixed asset register. If it says you have 12 corporate vehicles, walk out to the parking lot and verify the chassis numbers against the vehicle registration papers.
And make sure one of those 12 vehicles didn't quietly get sold to a manager 2 years ago without a proper capital gains tax calculation.
Precisely, because if the vehicle is gone but still sits on your register generating depreciation claims, that is an open invitation for a fraud penalty. And step 3. Do a complete bank-to-ledger lock. Every single inflow on your bank statement must be mapped to a specific invoice. If you have an unexplained credit of 2 million naira in your bank account, the NRS will default to calling it taxable revenue, even if it was just an internal transfer or a shareholder loan refund.
That bank lock is so critical. If you can't explain the deposit, the state will tax it. This really highlights that tax compliance isn't just an administrative chore you dump on your accountant every December. It is an operational design. How you organize your warehouse, how your drivers fill out logbooks, how your security guards log deliveries. All of it is tax planning in disguise.
You've put it beautifully, Oluwaseyi. Remember, financial freedom and business survival are not built by chance. They are built through knowledge, discipline, and consistent strategic execution. Don't let a missing paper trail from 6 years ago compromise the business you are building today.
Absolutely. Build the structure, keep the records, and sleep easy at night. Thanks for listening, everyone, and we will see you in the next episode.
Goodbye, everyone. Keep those records clean. Subscribe to us at Icon STV-T7i.